So we have some new shocking details revealed about the judge that just ruled against Elon Musk in Delaware. If you recall, about 24 hours ago, a judge in the Delaware court ruled canceling Elon Musk's $55 billion package. Now, we're not talking about that package, although that might be worth $55 billion at this point. We're talking about the payment plan, the compensation plan that was approved by 80% of Tesla's entire shareholders. She canceled it, and in fact, she's the same judge that canceled Elon Musk's ability to not buy Twitter. If you recall, Elon Musk had cold feet, second thoughts, whatever you call it. He didn't want to buy Twitter, and for good reasons. But that same judge, Kathleen McCormick, ruled against him in the Twitter case as well, forcing him to buy Twitter, now known as X. Now, it doesn't matter that X became a great platform and all that stuff. What matters is that this woman is 2-0 against Elon, and that's not even the shocking details. The shocking details is this lady was actually a partner for a law firm called Young Conaway. Now, I know it sounds like a boy band, but it's actually a very prestige law firm. And while she was a partner at that law firm, what happened is this law firm was one of the biggest donors to the Biden campaign. Not to mention that they were actually very tight with Congressman John Carney, a very, very close friend of Biden, and the guy who appointed or nominated Kathleen McCormick to the judge position in the Delaware court. In fact, in the March 2018 email from Hunter Biden, he literally said, and I'm reading verbatim, "I will bring the suit to the Chancery Court in Delaware, which, as you know, is my home state, and I'm privileged to have worked with and know every judge on the Chancery Court." He was threatening people with the lawsuit because he's basically saying, look, I got this court. Now, I don't know if this is political, if this is apolitical, if it's just a crazy coincidence, if it's a witch hunt against Elon. You be the judge. Get it? You be the judge. Not funny. Okay, let's move on. And now let's move on to the Daily MVP, sponsored by Stock MVP, your tool for stock market research for the long-term retail investor. Now look, in today's Daily MVP, I have to give a huge shout out to Elon Musk. I know, we just talked about him, but look, the way he responded to what happened in the Delaware Chancery Court is absolutely brilliant. Once we heard about this uber communist ruling, essentially saying that his compensation was unfair, and even though it was approved by 80% of the entire shareholders of the company, it was canceled by Kathleen McCormick. What he's done wasn't complain, wasn't cry about it, was not to get mad about it. When people hate on you, your natural instinct is to fight back, is to get bitter, is to get angry. But certain people, that 1%, they do not get bitter, they get better. And the way Elon Musk reacted to this story was absolutely mind-blowing. What he told everybody yesterday, he's not going to appeal this, he's not going to fight this, he's not going to make a big mess out of this. Instead, he's going to reincorporate Tesla in Texas and get a fair trial if needed. Simple, problem solved. No problem. You want to be communist? Go right ahead. And Elon Musk and Tesla will not be the only ones leaving Delaware. After a ruling like this, many other companies will probably follow Elon Musk to Texas and other states, as they should. And now let's move on to something that's not Tesla or Elon Musk. I know, shocking, right? Let's talk about what happened yesterday. So yesterday, Jerome Powell actually took the stage and he started talking about rate cuts. That was the first time we heard the Fed acknowledge, recognize the idea of rate cuts. And he actually said rate cuts in 2024 are possible. And the market loved it. But then, instead of running away quickly, Powell decided to take some questions. And that is where all the wheels came off. And this whole thing crashed like Grandpa in the 1986 Christmas party. Now look, the questions part actually got Powell to admit there's not going to be a rate cut in March. Now, I don't know why a lot of people hope for that. I don't know why some of the market priced that as a possibility. I've always said that there's 3 rates coming, and they're probably coming in the second half of 2024. But nevertheless, the market did not appreciate Biden actually saying the rate cut isn't going to happen in March, and then every single stock went to the toilet. And that ended in a very, very bad day. Now, what do I think about Powell's talk? What do I think about the policy? And where do I think this thing is going? Now look, Powell overall is very cautious, and I totally understand why. In the 70s, they had inflation under control, they loosened up a little bit too quickly, and then we had Paul Volcker going to 20% interest to control what happened with inflation. It came back with a vengeance. He doesn't want a replay of that. He doesn't want his name on the guy who came before Volcker kind of style. I totally understand this, especially if the economy is doing good, GDP growth is absolutely insane, and there's no unemployment, the market is steady, the market is good. Why rush it? be cautious. I totally understand it. The risk management aspect of it makes perfect sense. I think it was a good decision, and I think it also shows us that the first rate cut is probably going to come in May or June this year. And this is where the Fed will start to loosen up a little bit. Now, one person that really loved what happened yesterday was Jeffrey Gundlach. He was saying that he's actually nervous about people talking about the Goldilocks scenario, about March rate cuts and how euphoric it's all going to be. And he basically said, look, when you have this groupthink about this beautiful kumbaya around the campfire, it's usually where I get freaked out the most. It's kind of the equivalent of Warren Buffett saying, look, when everybody's bullish, I'm bearish. So Gundlach was saying, look, when everybody was celebrating that it's over and that rate cuts are coming in March, I was basically saying, why? And he still expects a recession in 2024, which is actually on the other side of the spectrum right now from what is the consensus. And he said, look, I'm preparing cash on the sideline because I think the stock market is going to go down and I'm going to buy a lot of cheap companies because of you bozos who are absolutely euphoric for no reason about the stock market, and you will buy it at the high and then I'll buy it off you at the bottom. Now, look, I don't know if Jeffrey Gundlach is right or wrong, but let's talk about it. Let's look at how stocks behave after the first rate cut of the Fed. A research that was published just actually checked that point exactly. What the stock market does historically, statistically, after the first rate cut following a restrictive monetary policy. And according to that research, Jeffrey Gundlach isn't in the good spot right now because statistically speaking, the Dow and the S&P 500 do about 50% in the year that follows the first rate cut following a long period of restrictive policy, which means that it's going to be about 50% above the normal S&P 500 good year. Now, if you actually break it down into two pieces, here's where it becomes more interesting. If the recession is actually something that follows the rate cuts, which may happen, in fact, it happened before because usually the Fed starts to cut rates when things get bad, so there's a good chance a recession follows. If that happens, the stock market does about 10% in the following year. But if there's no recession that follows the rate cut, which means if the Fed cuts on time before a recession is on the rise, then the stock market does 24% in the following year. So, no matter how you spin it, statistically, historically, we're between 10% and 24% following the Fed rate cut for the first time. Does it mean that it's a good indicator about what happens in the future? Hell no. There's no way to indicate a future based on previous statistics historical data. Don't even think about that. But that's a good lesson to show you how the markets behave in the past. Of course, this might be an outlier year when everything goes crazy, so don't bet on it, of course. Stay the long term, DCA, you know the strategy. I'm not going to repeat myself a million times. Now, let's talk about earnings. We had Google and Microsoft come out with good earnings, but they couldn't stop Jerome Powell from flushing the entire market to the toilet. We've seen that happen. Now, if you look at the numbers, Google and Microsoft had good earnings, especially if you focus on the cloud numbers. Absolutely insane. It's always going to be bumpy, lumpy, I get it. But as long-term investors, think about 2027. Think about 2028. Now, would you take a bet for me that Microsoft is not going to be a $4 trillion company by 2027? I don't think you take that bet. And these stocks are exactly the sort of stocks you want to have in your portfolio for the long term. Now with Apple, Amazon, and Meta, it's very, very simple. One sentence for each. Apple, great products. The rumors of the death of the iPhone were premature. And the services is a huge S-curve for Apple in the coming 10 years. And what about Amazon? 3 letters, AWS. The building blocks of the entire new generation of companies is on Amazon. And what about Meta? They had a little fling with the metaverse, and I've seen the work that they've put out. It's actually not bad at all. But their bread and butter will continue to be services. Their revenue is coming up. They will still be a cash machine for a long, long time. So I wouldn't bet against that as well. Long term. Everything is said here is long term. And as always, make sure you check out Stock MVP, stock-mvp.com, a platform I've built for retail investors to research stock for themselves, not listen to mainstream media or me. Also, check out our Patreon and our Academy, patreon.com/Tom Nash. If you want to learn how to become a better investor, see you in the next video.